Did you know about 50% of self-employed mortgage borrowers struggle to get approved for a home loan? And the crazy part is, it isn't usually because they don't make enough money. It's because the lenders are calculating income completely differently for self-employed borrowers versus a W-2 earner. So today, I'm going to walk you through why self-employed borrowers get denied, how to fix it, and the loan programs that are specifically designed for business owners. So what I see, the number one reason why borrowers get denied is because their tax returns. When lenders are reviewing a self-employed file, they aren't looking at gross business revenue. They're looking at taxable income after deductions. And so if you're a business owner doing what most smart business owners do, which is taking advantage of the tax code, their income on paper can look much different than what you actually earn. Another issue lenders see is inconsistent income year over year. Traditional mortgage guidelines typically require 2 years of self-employed history and stable income trends. And then there's something that I see all the time, and this is commingling of business and personal accounts. And so this basically means that the business deposits and the personal finances all run through the same account. And this can make it very difficult for the underwriter to determine what income is actually usable. And finally, sometimes the borrower is simply applying for the wrong loan program. Not every self-employed borrower fits into a traditional, conventional, or government loan. So how do you avoid getting denied? The first step is mortgage planning, and this happens before you file your taxes. If you know you're planning to buy a home in the next year or two, it is important to work with both your CPA and your mortgage professional to make sure your income will qualify. Sometimes a small adjustment in how income is reported can make a huge difference in qualifying for a conventional loan. The second thing is keeping clean business records, separate business and personal account whenever possible. This makes documenting income much easier during the underwriting. And the third thing is simply understanding that traditional mortgages are not the only option. Today, there are several loan programs that are specifically designed for self-employed borrowers. And let's talk about a few of those. The first one, most common, is called a bank statement loan. These are one of the most popular options for business owners. Instead of using tax returns, lenders review 12 to 24 months of bank statements. They look at the total deposits of approved or verified business account deposits going in, and then they apply a percentage of those deposits to calculate qualifying income. This can be a much better option for borrowers who take significant deductions. The second is a profit and loss. These are very, very popular and basically use a CPA or self-prepared profit and loss statement. This document shows the income and the expenses of the business and can sometimes be used in combination with bank statements, or some lenders just allow you to use just the profit and loss. There's also asset depletion loans. These are for borrowers with significant assets. And it's basically where they take the total qualifying asset and the lender divides it across a certain amount of months. Sometimes it can be 36, sometimes it can be 60 months. It just depends on what the guidelines are. And those are based on liquid assets such as savings, retirement accounts. And this can work very well for borrowers who have strong assets but lower taxable income. And finally, the easiest one for no income qualification at all, these are specifically for investors, but they're DSCR loans. And DSCR stands for debt service coverage ratio. And these loans qualify based on the cash flow of the property itself, not the borrower's personal income. If the rental income covers the mortgage payment, many investors can qualify without providing traditional income documentation. So, the biggest mistake I see self-employed borrowers make is assuming they won't qualify for a mortgage. In reality, they just often haven't been shown the right strategy or the right loan program yet. If you're self-employed and thinking about buying a home or interested in real estate, it's important to explore all of your options before assuming it's not possible. And you can apply simply using the link below. or go through my website to run different loan scenarios. And if this video helped you understand how mortgages work for business owners, make sure to subscribe for more mortgage strategy tips. Thank you again. Like and share.